Hello friends, let's understand how to reimagine one's own business with 3 quick tools of analysis. The first one is revenue. This is the core reason why anybody starts their own business is your revenue or sales or turnover. The first and important thing is to look at the net revenue. So when we say net, it's minus of all the taxes, predominantly your GST, because that's the money which comes into your pocket. Now, when you're comparing your revenues, you need to look at the most minimum this year versus the last year. So if you're in FY23, compare it with FY22. Remember, this is the base minimum. What you should look at also comparing it with is the quarter-on-quarter revenue growth or the month-on-month revenue growth. Now, when you're comparing quarter-on-quarter or month-on-month, it's very important to understand the nature of your business. So if your business is seasonal in nature, you have to compare the relevant quarter. So for example, if you're in hospitality business, you should compare the quarter of this year versus the quarter of the last year. Whereas if you're in a regular business, you can compare the quarter of this year versus the last quarter which has just happened. So for example, quarter 3 versus the quarter 2 of the relevant financial year. Similarly, you can do a month-on-month comparison as well. Now, it's not only the total revenue which you have to consider, but you can do an analysis of different KPIs or key performance indicators of your business. So for example, you can do a revenue comparison of geographies, you can do a revenue comparison of products, you can do a revenue comparison of customers. So it really depends upon how much deep and segmentation you want to go in terms of your revenues. So the first and important parameter is revenues. The second one is EBITDA. I'm sure you have heard of this concept many times. It's a very fancy term which people keep using in a very fashionable way. EBITDA is earnings before your interest, tax, depreciation and amortization. Before. So you need to understand what is not included as a part of your EBITDA. That's basically your interest, depreciation and taxes. The reason is these 3 are not in your control. So when somebody starts the business, they may decide to invest completely their money or may decide to take it from the bank. So accordingly, your interest might be full, quite large, or it might be zero. Similarly, tax is not in your control. It depends upon the government and which geography you start your business. And similarly, depreciation, you may decide to take your assets completely on lease, in which case your depreciation will be zero, or you may be heavily invested in your assets, in which case your depreciation will be very large. So these 3 elements are something we don't compare. The rest of it, all the costs which you minus from your business or your revenues, that becomes your EBITDA. This is the true recognition of your profits from your business, and that's why we compare or we look at EBITDA very particularly. Now, when we are comparing EBITDA, we should compare it the same way we compared revenues. So it could be year on year at the minimum, it could be quarter on quarter, it could be month on month. Again, you have to compare it based on whether your business is seasonal or not. However, one additional thing one needs to compare your EBITDA with is a very important parameter of your percentage of EBITDA to your business. So for example, in the last financial year, you realize that your EBITDA to business was 22%. And this year you realize it's come down to 20%. You need to look at where that additional 2% was lost. In a way, your EBITDA is like a pie. You need to understand what portion of your pie was eaten up by the certain costs. So you realize, for example, your employee cost, which was last year 30% of your revenues, has now increased to 32%. So you need to understand where that extra 2% went. Similarly, what other cost caused that EBITDA percentage to come down as a percentage of your sales? Remember, EBITDA is a very important part of analysis that you need to do. Third one is your working capital. Many times I'm posed this question that I've worked so hard, my profitability shows so much of money, but where is the money gone? The money is gone in your working capital. So working capital has 3 major components. It's your debtors or your receivables, it's your inventory or your stocks, and it's your creditors, the money payable. Now each of these play a very important role in blocking your money or releasing your money. Each of these has to be studied in terms of the number of days of the relevant item. So for example, if you're looking at debtors, you need to see how much money is blocked in your debtors as compared to your sales. So let's say my debtors are 30 rupees and my sale for the whole year is 100. It basically tells me that 1/3 of my yearly sales has got blocked in debtors. The simple formula is you take your debtors divided by your yearly sales and multiply it by 365. The same formula you need to adopt for your inventory and creditors as well. Now these three put together, so your debtors number of days plus your inventory number of days minus your creditors number of days tells you what is your working capital cycle. You need to endeavor to keep the number of days after taking this formula into consideration to the minimum. The bigger your number looks in terms of number of days, it means that much money, that much amount of money is got blocked in your working capital. So one needs to be very careful about using these three tools, which is very simple for one to use to actually have a better analysis of your business. To recap, it's your revenue, which you need to look at in close detail, it's your EBITDA, and finally, it's your working capital. Use these three tools on a regular basis to reimagine your business and grow further. Thank you.